Hello everyone, the FOMC meeting has concluded last week and the Fed has decided on a 75 basis point interest rate hike, which caused more sell-offs in the stock market. So what's next moving forward? In this video, I will give a quick recap of what exactly had moved the market last week and also my thoughts on the current market. As usual, I will also be covering some simple technical analysis of the various mega cap stocks. Anyway, if you like such videos, I hope you can help me with the like and subscribe buttons. Your small action means a lot to me and the YouTube algorithm. Okay, so what happened last week? In case you are not aware, the stock market suffered the largest weekly percentage decline since March 2020 during the COVID flash crash. This is likely a result of the Federal Reserve raising the interest rate by 75 basis points, which is the most since 1994. Interestingly, the market actually rallied a little when Jerome Powell came out to speak, but the very next day, the market was in the sea of red. As the saying goes, news take about a day to digest, and I believe investors assess that the Fed's latest monetary policy decision to curb the hottest inflation in 4 decades will have negative impact to the economy and the stock market. The fear that high inflation and tighter financial conditions could derail the economy is very real at the moment, and it appears that a recession is inevitable and unavoidable. Another thing to highlight, the S&P 500, aka the most reliable benchmark of the stock market as a whole, is down about 23% since the start of the year. And a not so fun fact, this is actually the third worst start to a year in history for the S&P 500 in the first 115 trading days. So good job to you if you still believe in staying invested. We are all in this together. Anyway, what's next? Don't fight the Fed, they say. As the Fed turned more hawkish and went from the originally planned 50 basis point increment to 75 basis point, it means that we are likely not out of the woods yet. Probably more bloods in the streets ahead. Once again, this is not financial advice, it's just my personal view. Before I move on to the technical analysis portion, I thought I should share my view on some of the misconceptions that some investors have, and that is the ability to predict the market movement for the next trading day or week. I'm not sure if there are financial gurus out there who can do it, and even if they can, I don't quite believe they can do it on a constant basis. The reason why I'm explaining this portion because I have received questions such as, will tomorrow be green, will the market fall next week, or will this stock goes to this price level on this date? Therefore, to clarify, I don't have a crystal ball. My approach is always let the market makers go first, and then we the retail investors follow along. Case in point, I shared these pointers last week on Mumu. VIX resistance are at 29 and 31, and if it goes above, the market will be very red. SPY has strong support at 385 and 380. If both breaks, we could see 360s range. For Apple, if it doesn't hold 136 and 137, we will likely flush down quickly to 132. So all this happened last week, but if you notice, there is always a prerequisite or condition, aka support or resistance levels. This is what I meant by letting the market makers go first. If key levels are broken, then it is likely to head towards a particular direction, depending on whether is it a support or resistance level. But if we really want to talk about prediction, the closest to prediction that I can offer is my view of the market in weeks and months ahead. Even such predictions can be subject to change quite quickly. Say hypothetically, Fed pivots their hawkish tone next month, or CPI data drops drastically in the next 2 months, then my view of the choppy summer could change. By the way, a quick one, if you have found some value in my views of the market, I hope you can help to like and subscribe, and hoping to hit 1k subscribers someday. Okay, now let's move on to the technical analysis segment. Let's start things off with SPX. Why SPX and not SPY this week? Reason is because I spotted something interesting on the chart. A long-legged doji candlestick was formed on last Friday, and this pattern indicates that there is an indecision between the buyers and the sellers at the moment. The noteworthy thing is that there is very high volume on that day, and this could mean that buyers are stepping in and can be a sign that sentiment is changing. There could be a potential trend reversal in the short term. With that being said, do note that this is not guaranteed, and the confirmation would be when the price closed above the tip of the doji candlestick at around 3707. When you translate this to SPY, it's around $370. So as usual, let the market makers go first. Keep a lookout and see if SPY can close above 370 for a rally. On the downside, if the market continues to flush down, SPY could hit towards the next psychological level of 350, followed by 345 where the 50% Fibonacci retracement level is on the weekly chart. Moving on to Apple, you can see that it closed right above the red downward channel that I have drawn previously. But don't be too excited yet, as we need at least 2 candles above this trend line to confirm a rally. For a slight breakout to the upside, it needs to go above 140 and fill the gap between 140 to 142. On the weekly chart, there is this support line at around 137, which the last time when Apple was below it was in June 2021, about a year ago. So in my view, Apple is looking bearish now. We may go up to the levels that I have mentioned, 137 and maybe even sub 140 before going down again. So on the downside, personally, I think 115 to 120 presents another good entry point for long-term investors. Alright, here's a quick update on my option trades for Apple. In my previous video, I shared that 2 of my June contracts expired worthless, and then I sold a new Apple put at 120 strike price, which will expire on 15 July as shown in the left image. Then last week, when Apple gapped down on Monday, I sold another put contract at 110 strike price, expiring 22nd July. Let's see how these 2 contracts turn out in the next few weeks. Next, Tesla. The stock is still within the downward channel indicated by the 2 red lines. I am still of the view that we will retest the recent low of 620, unless it breaks above the downward channel. On the upside, the resistance still remains the same at 700 and 746. Whereas on the downside, while I have to zoom all the way out, the key levels to watch would be the psychological level of 600. And if that breaks, there is this little gap between 566 and 571, which will act like a magnet and pull the stock towards it. After which, the next support level is around 540. Moving on to Microsoft, the stock filled the gap which we talked about in my previous video at around 244 and 245. And there is this consolidation zone that I have been mentioning since the longest time, which is around sub 200 to 220s. Previously, it appears to be a little far-fetched when the stocks was at 270s and 280s range. At the moment, it seems possible, but not guaranteed though. My price entries are still at sub 240 and of course waiting patiently for sub 200 if it ever comes. Once again, going back to the weekly chart and mentioned in my previous video, 238 is a key level in my opinion. If that breaks, 220s range could come quite quickly. Next, we have Nvidia. Not looking good at the moment as there is a descending triangle formed on the chart, shown by the yellow lines. For your knowledge, descending triangle is usually a breakdown pattern, aka a continuation of a downward trend. That being said, nothing is guaranteed when it comes to chart reading or technical analysis, so keep a lookout for the support line at around 153. Previously, I've also drawn this green line of support at around 150. So keep a lookout for these 2 crucial levels. If they break, there are 2 gaps below which will likely act like a magnet to pull the stock down. The 2 gaps are 146 to 148 and 140 to 142. On the flip side and upside, the first level of resistance to clear is around 178, followed by around 207. At the moment, it seems like a long way to go. Okay, now let's talk about Meta, aka Facebook. On the weekly chart, there is this super long-term upward trend indicated by the green line, which stretches all the way to around August 2015. That's like almost 7 years ago. And if you zoom in a little, you will notice that the trend line has been broken last week when Meta closed below it. In short, this is a very bearish trend in my opinion. Switching to the daily chart, there is a tiny gap at 157 to 158, and it looks like we are not too far from filling it. If the market continues to go down or if Facebook reports poor numbers in July's earnings call, I will not be surprised to see if it headed towards pandemic low of about 137 followed by sub 120s. If Meta trades at this level, in my view, this is a good buying zone. As we officially enter the bear market, some investors prefer to hold cash and not buy the dips at all, while others would still want to stay in the game. So for the latter, how can investors navigate such stormy situation? As I have always mentioned, if you know option trading, you will be able to still make money despite the current bearish trend. To put it simply, in every market there are opportunities for both bulls and bears to make money. For the current market, I have also shared that this could be the sell the rip and short the rally market. But a quick disclaimer, option trading is a high risk activity. For long-term investors, just to share, the strategy that I am adopting is... Yes, my strategy is slowly dripping my money into the market at key support levels. As simple as that. Alright, some quick end thoughts to wrap the video up. Bear market comes every few years. This means opportunity to sweep up good company stock at cheap price only appear every few years. Some may be wondering, since I am of the view that there is more downside and more blood on the streets, why don't I hold cash and wait to enter at a later date? Well, my answer is, what if I'm wrong? I mean, experts and financial gurus can call the bottom wrongly, let alone me, a newbie in investing. So yeah, I hope you get my point. What if the so-called extreme bottom or crash doesn't come? Or what if it comes, but I don't know where is the exact bottom? And I waited and waited, then I mistook the recovery as a dead cat bounce, then the market shoots up. Therefore, my plan is to slowly put my money into the market at this stage. Then when there is sign of reversal, for instance, Fed changes their tone, inflation is curbed, war has ended, then I will unload my cash at a faster rate. So if the recovery happens too fast, at least I don't lose out too much. Lastly, I feel that I survived 2022's market will be an achievement in future. It will be a milestone where I look back and glad that I stayed invested. Alright, that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. I need 1k subscribers. They mean a lot to me and will keep me going. Thank you.